Silver traders, listen up. Today's move looks like just another pullback, but on the chart, silver is literally sitting on a line that can decide whether we're going back to 77 or lining up a fresh run towards 92 and beyond. I'm OG John AG, and in this video we're going to break down exactly what FXStreet is seeing in this latest forecast and what it really means for you if you're trading or stacking silver into 2026. Hook and setup. Right now, silver just got smacked down from the 86 area, the weekly high, and is drifting around the mid-82 zone, more than 2.5% lower on the day. On social media, that just looks like, oh, red candle, dump Hogaya. But on the chart, something much bigger is happening. Price just failed near the 38.2% Fibonacci retracement of the entire drop from the all-time high. Momentum indicators are screaming tired bulls, and price is still stuck under a rising 200-period moving average on the 4-hour chart. In other words, silver is not dead, but the burden of proof has shifted back onto the bulls. If you trade silver without knowing these levels, you're basically driving at night with the headlights off. So let's switch the lights on. Segment 1. What exactly just happened? First, let's talk about today's move in plain English. FXStreet notes that silver attracted sellers in the Asian session on Thursday, gave back a big chunk of Wednesday's rally to the 86.30 area, which marked this week's high, is now trading just below the mid-82s, down over 2.5% on the day, but still inside the range it's been stuck in since the start of the week. So this is not a full-on collapse. It's more like bulls tried to push through a key level. The market said, not yet. Price got slapped back into the same old range. That key level? The 38.2% Fibonacci retracement of the entire slide from the all-time peak. Whenever you hear 38.2, 50, 61.8 on a serious macro chart, you know the big players are watching that area. This 38.2% band basically acted like a brick wall for bulls, at least on this attempt. Segment 2, why the 38.2% Fibonacci level matters. Let's zoom into this Fibonacci story because that's literally in the headline of the article. FXStreet points out the overnight failure near the 38.2% retracement of the recent fall from the all-time high. The rejection from there, followed by a drop, is a be careful signal for bullish traders. Here's how to think about it. You had a big down leg from the record high. Fibo retracements mark zones where counter-trend moves often stall. 38.2% is usually the first big test for any bounce. If bulls cannot convincingly clear that 38.2% band, many macro traders treat the move as just a relief rally, not the start of a new bull leg. That's why the article explicitly says a sustained breakthrough 38.2% would be the trigger for serious bullish conviction. So right now, we're in this weird zone. Bulls showed some strength, but not enough to reclaim 38.2%. Bears stepped in right where textbook sellers are supposed to step in, and you, as a trader, have to decide, is this a dip to buy or a sign that we're not ready yet? Segment 3, MACD and RSI, the energy meter of this move. Now let's talk indicators, because the article gives a very specific read on MACD and RSI. FXStreet notes, MACD line is above the signal line. MACD is also above 0, so we're still in positive territory. But the histogram is shrinking, which tells you the upside momentum is fading. Think of it like this. MACD above 0 or trend bias still tilting bullish on this time frame. MACD above signal-less bulls still in charge, technically. Shrinking histogram. Shocker, the bulls are tired. They're not pressing the gas as hard anymore. At the same time, RSI is sitting around 50.89, literally neutral. Neutral RSI plus, tired MACD plus, failure at 38.2%, Fibo, no clean trend. A high-risk chop zone where you can't just blindly buy breakouts or sell breakdowns. You need precision, levels, context, and patience. Segment 4, the 200-period moving average, the invisible ceiling. On the 4-hour chart, FXStreet highlights one more major piece, the 200-period simple moving average. Details. The 200 SMA on the H4 chart is trending higher around 87.42. That's usually a bullish sign. The longer-term trend on that time frame is sloping up. But, and this is crucial, the price is still below that moving average. What does that mean? A rising 200 SMA says, structurally, this market is trying to turn up. Trading below the 200 says, price still hasn't proven it. Rallies are being capped. So as long as silver stays under that 200-period SMA, every bounce has to be treated as suspect. Bulls need a sustained move above that 87.40, 87.50 area to really flip the broader tone more constructive. The article is very clear. A sustained move above the 200-period SMA would be required to improve the broader setup. Until then, it's like driving with the handbrake half pulled. Segment 5, the map, 77, 82, 86, 92, levels you must know. Now let's draw the battlefield because FXStreet basically gives us a full roadmap of key levels. Here's how the levels line up. Current zone, mid-82s, after rejecting near 86.30 weekly high and the 38.2% Fibo region. Resistance 1, 85.87. This is the 38.2% retracement. Article calls this the initial resistance. A clear break above this level opens the door to higher retracements. Target above, 92.59. This is the 50% retracement of the entire downfall. If silver convincingly clears 85.87, the natural technical magnet becomes this 92.59 level. Support below, 77.56. This is the 23.6% retracement. Failure to clear that 38.2 band could drag silver back towards this 77.50 area. Put another way, above 85.87, bulls start taking control of the narrative. Holding above 87.40, that 200 SMA, the trend starts looking like a real recovery. Failing repeatedly at 85.87 and slipping back under 82, risk builds for a retest of that 77 zone. If you're planning trades, these are the zones you build your plan around, not random round numbers. Segment 6. Is this the start of a bigger drop? So the question everyone asks on days like this, John, is this the start of a bigger dump back to 77 or just a healthy pullback inside a bigger recovery? The article's tone is actually quite balanced. On one hand, we have a clear rejection at a textbook resistance, 38.2% Fibo. Momentum is cooling off. Price is still below the 200 SMA, which means the market hasn't earned the right to be called fully bullish. On the other hand, silver is still in the same range it's held since the start of the week. This isn't a full breakdown. MACD is still above zero and above the signal line. The bullish impulse is wounded, not dead. So the message is, it's too early to scream trend reversal. It's also too early to scream new breakout leg. We are in a decision zone where the next few sessions around 82.86 will tell you everything. If we see strong buying from this mid-82 area, followed by a break and daily close above 85.87, then this drop will look like a buyable dip. If we see more failures near 85.86 and a decisive move down through recent range lows, then 77.56 comes into view, and that's where dip buyers will be tested for real. Segment 7, bigger picture, why people care about silver at all. At this point, you might be thinking, okay, John, that's the short-term technical picture, but why are people even watching silver like hawks in 2026? FXStreet's own FAQ at the bottom of the page reminds you of the big picture. They highlight 4 big themes. Store of value, JAR hedge silver has a long history as a store of value and a medium of exchange. Investors still use it for diversification and as a hedge during periods of high inflation. Relation to interest rates and the US dollar silver is a yieldless asset, so lower interest rates tend to support it. It's priced in dollars, so a strong USD usually caps silver, while a weaker dollar is supportive. Industrial demand silver is deeply embedded in industries like electronics and solar energy. It has one of the highest electrical conductivities, even more than copper and gold. Demand from the US, China, and India through industry and jewelry helps drive price swings. Silver versus gold. Silver often follows gold's lead as a safe haven asset. The gold-silver ratio helps traders judge which metal looks cheap or rich relative to the other. So even when you're trading a short-term rejection off 38.2% Fibo, understand, behind that candle is a tug of war between macro, rates, dollar, and real-world industrial demand. That's why silver can be such a high-beta emotional market. It's not just one narrative. Segment 8, how a prepared trader uses this kind of forecast. Let's talk about you. How does a prepared trader use a forecast like this, instead of just doom-scrolling headlines? You don't blindly follow it. You translate it into a plan. From this FXStreet piece, your actionable checklist looks like this. Mark 82, 85, 87, 87.40, 92.59, and 77.56 on your chart. Treat 85.87 as the gatekeeper. No real breakout story without a clean, sustained break above. Watch how price behaves around the 200 period SMA on the 4-hour. That's your broader trend filter. Let MACD and RSI confirm or contradict price action. If price breaks 85.87 but MACD is flattening and RSI is diverging, be cautious on chasing. If price retests 82 or 77 with strong bullish reaction and improving MACD, that's a higher quality dip. Remember what FXStreet itself says in the legal text. All of this is information, not investment advice. Markets are risky, and losses are your responsibility. So you use their map, but you drive your own car. Segment 9. Final word and viewer call to action. Right now, silver is at one of those classic prove-it moments. Bulls had momentum, hit a Fibonacci wall, and lost steam. The bigger trend wants to turn up, but price hasn't yet crossed that key moving average barrier. The next battle around 82.86 will tell us whether we're setting up for 92 or drifting back to test 77. If you want to ride this market without getting chopped to pieces, respect the levels, respect the indicators, and respect the fact that silver is both a safe haven story and an industrial powerhouse, which is why it moves the way it does. You've been watching John AG here, and I'm OG John AG. If this breakdown helped you understand what that 38.2% Fibonacci holds the key headline actually means for your trading, hit like so YouTube doesn't bury this under noise. Smash subscribe if you want real talk macro and levels, not recycled hype, and drop a comment. 82 to 92 or back to 77. Tell me where you think silver is headed next, and more importantly, why. Because here, we don't just chase candles, we hunt context.